My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I do want to make friends. I'm just trying to make a little money. My job's not just to entertain, put it in context, educate. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. You and me, we need to talk about the hardest part of investing. We can all more or less figure out the so-called macro, the big picture economic situation, including the Federal Reserve, which will feed into the market. We can figure out individual companies. Or if we're willing to do the homework, especially now that we're in the heart of earnings season, and all these enterprises are giving us the quarterly updates, we can get that. But there's a third factor nobody talks about, and we're going to change that tonight. We need to talk about, on this ultimately sedate day, where Dow advanced 104 points, S&P dipped 0.07%, Nasdaq declined 0.27%. We got to talk about why stocks really move. And that's about time frame. The time it takes for a good story to come to fruition. This is something that bedevils even the professionals, so don't feel left out if you're an amateur or a home gamer. Let's take a recent example. Yesterday, a prominent Wall Street analyst upgraded AMD Advanced Micro Devices shares to the equivalent of a buy rating, saying that it's time to buy AMD as the shares simply don't reflect the greatness of the semiconductor company's future. That call moved the stock up nearly 10% yesterday, a remarkable achievement, given that it was really just entirely from one analyst's suggestion. Today, though, AMD gave back a big chunk of those gains, down more than 2%, but way lower mid-morning. Why? Because another analyst downgraded from buy to hold.
Don't buy, don't buy, don't buy, don't
buy. In this case, because yesterday's monster run simply doesn't reflect the near-term, not the long-term, but the near-term future, which is unremittingly bad and possibly getting worse. Who's right? The bull or the bear? You'd think they can't both be right, wouldn't you? Wrong! They're both absolutely right. And this dichotomy is one of the things that makes it so difficult for people to pick individual stocks, including AMD, which we still own for the travel shops precisely because of this timing issue. All right, the bearish analysts, right as rain, because AMD's business is awful now and shows no sign of improving. But over the long haul, the bullish analyst is going to be right, because eventually the semiconductor downturn will end. And when business comes roaring back, so will the stock of AMD. The difference between these two calls is simply the time frame. First, you need to know that CEO Lisa Su has transformed AMD from an also-ran semiconductor enterprise into a dominant chip maker in gaming, personal computers, and high-performance computing. Think the big data companies and how much power they need to run their web services. Think Microsoft tonight, which talked about how great Azure's doing. Unfortunately, all these businesses have indeed peaked for now. In fact, they peaked while AMD was still pumping out chips for those end markets like there was no tomorrow. Now, some of that was a judgment the business remained strong, seemed reasonable, but a lot of it came down to what's known as double ordering, where clients like the PC makers place more orders than they need because they're so desperate to keep up with demand. They're afraid to miss out. Some of it's because everybody in the industry misjudged the short-term nature of the semiconductor shortage, at least the part that involves that I'm talking about. It lasted roughly as long as the pandemic, then evaporated. Every client was suddenly stuck with massive amounts of inventory. Every middleman who provides chips was suddenly overflowing with them. And still, the semiconductor companies kept pumping them out. They're often the last to know. They found out the hard way last quarter, though, when almost every semiconductor company blew up, meaning the earnings were so poor, so below the earnings estimates of the brokerage firms, that they had to pre-announce their weak numbers because of the giant inventory glut. Ever since then, the chip makers have been trying to get back into Wall Street's good graces, but they just can't. They've made fewer and fewer chips, in some cases like Micron, which has a hellacious glut, compounded by the unwillingness of competitor Samsung to slow its lines down, have actually cut back orders for machines to make new chips. Well, that's one way to stop a glut, but only if everyone else goes along. So now let's get back to why both analysts, the Barclays bull and the Bernstein bear, could end up being right. Let's start with today's downgrade. Now, the gist of the piece is pretty simple. There's no let-up in the lack of demand for the end products. It still makes no sense for AMD's clients to order more chips. There's still a glut. In fact, Bernstein insists that the inventory's only gotten worse, not better, which is mind-blowing given the fact that PC sales were down 22% year over year in the fourth quarter. I think that Bernstein could be right about an overall continued decline. So how can the bull at Barclays be right? Because he actually concedes that 2023 is going to be a big disappointment. There's nothing in this upgrade for AMD and a host of other semis, including two more charitable trust names, Qualcomm, which also got upgraded, and NVIDIA, which received a huge price target increase. That indicates he's looking for upside surprises for this quarter, or even the next one. But that's really NVIDIA alone, and it has to do with a particular kind of AI platform they have. However, you have to understand how big institutional money managers work. If you truly believe this horrendous inventory glut will end and the industry can get back on track, then you can't possibly wait until the end of the year to start buying something like AMD in anticipation of 2024. If you're an institutional investor and you have to buy millions of shares in order for your position in AMD to make a difference to your overall portfolio, that takes a lot of time. You also want to get in ahead of everyone else, especially if it turns out that a reopened China begins ordering more chips by the fall. That's possible. But if you're Bernstein bear, you're thinking, no one wants to go through the hell that awaits you if you own AMD this year, so you might as well just get out now.
Sell.
Right into the strength created by that Barclays upgrade. It helps that some of what happened yesterday was clearly short covering, not natural buying. The semis have been a losing battleground for ages for the bulls. So why not do a little bullfight, knowing that the near-term quarters are going to be bad? So in the crazy world of Wall Street, it's not enough to think about the company or the sector or the asset class or the macro, including the Fed. You also need to consider the reaction and even the reactors themselves. I personally believe that AMD, NVIDIA, and Qualcomm could indeed get hurt by earnings, but I also know from yesterday that from now on, the bulls will use every decline in these stocks to do some buying in anticipation of the next upcycle, because it always is that way. You always have to jump the gun. You just don't want to be too early, but I think we've seen the bottom. We're sticking around in these stocks for the charitable trust because, as we tell members of the Investing Club, we're willing to be patient for great companies, and that's precisely what AMD and NVIDIA are. Eventually, they'll turn around. I don't know when, but I'd rather be too early than too late. Of course, this isn't just about semiconductors. We saw so many cyclical stocks erupt today because some cyclicals are actually just doing really well right now, even with higher rates. That's the feeling I got from Raytheon. We saw Greg Hayes this morning on Squawk on the Street. Amazing story about aviation backlog. Same with D.R. Horton, gigantic home builder, putting up some amazing numbers. Best of all was PACCAR. You might not know them. They design and produce trucks, which is fantastic for everything that goes into a truck, and for Cramer, Fave, and Trust Holding, Caterpillar.
Buy.
The one area that seems just destined for hardship, though, remains tech. Today, the Justice Department decided that it wants more competition in the marketplace, so it's taken a shot at Google again. 10 years ago, we coined the term FANG on this show. The group remains snake-bitten. Fortunately, Microsoft, hey, that M never got into FANG, reported a gigantic upside earnings surprise, very strong cloud numbers. Much needed good news after the recent layoff announcement. But the bottom line, as we head into the heart of earnings season, I need you to understand that the reaction is often right, depending upon your time frame. However, it can also be wrong, as we'll talk about later. Either way, if you have conviction, the reaction can often be a great opportunity to buy, or sell. Let's start with Barry in Florida. Barry!
Hi, Jim. Thanks for the opportunity to be on the show.
You're quite welcome.
I've been a club member since its inception.
Thank you.
Disregarding the debacle this morning, my question about is about Wells Fargo. It represents a larger segment in my portfolio, and the result of a failed strategy, I am down about 17%. With the X-date coming up in early February, I don't believe it's a sell, but I'd like to get an idea from you as to whether I should buy more or just hold.
Okay, I want you to buy more Wells Fargo. It's a big vision for my trust, one of the biggest. I have to tell you that there was a machine breakdown where I had it down to 40 today. And on Squawk on the Street, I said I want to buy every share, hand over fist. But Wells at 44, with Charlie Scharf doing his magic, is a great buy. Don't worry about being down 17. Take the long-term view. The stock was at 62 in February 8th of 2018. Bill in my home state of New Jersey. Bill!
Hey, big Bergen County, booyah daddy from a Giant fan.
Oh, man, how much do I love Bergen County? One of my favorite counties in New Jersey, just for the record. Okay.
I'm still licking my wounds as a Giant fan, Jim. I need your help. I got some capital I want to put to work, and I'm thinking about Realty Income Corp. I like the dividend.
I
and
like your
I'm
idea. I think your idea is a great one. I wish more people had your common sense, because letter O is a terrific buy. A lot of people don't think it has the growth. They're wrong. I like it very much. I'd like to take another. Oh, you know what? I am not going to be able to. And you know what? That's a shame. Anyway, if you have conviction, the reaction could often be a great opportunity to get in or get out. Well, Mad Money tonight, NASCAR. Holy cow, where's my helmet? It's celebrating its 75th anniversary, and I'm learning more about the brand's legacy and future with the organization's top brass. And racing legend Jeff Gordon joins me as well. Then energy was the top performing sector in 2022, but not so great in the second half. And now that 2023 is in full swing, what should you do with the oil service companies? I'm drilling down on a handful of names to give you my take. And Logitech, one of our faves, plummeted after prelim earnings. So now that the report has been handed in, what did Wall Street dislike about the story? I'm getting some answers with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.